Hey guys, how's it going? It's Andy from MagooInvesting. Welcome back. In this episode of me talking crap about your favorite company, today we're going to be talking about Netflix for a second time. And I'm totally kidding about that. I want to kind of put this out at the very beginning saying, because I got a little bit of flack for my Uber discussion. And so I'm not hating on anyone that currently owns Netflix. I'm just giving my opinion on why I don't think I'll ever be taking a position in Netflix. So I've already talked about Netflix a couple months ago, but with earnings coming out this week, and just kind of some of the things I saw from that earnings report, I thought it'd be a good time to kind of explain my stance on the company. And before we get started, I got to say that I'm not a licensed financial advisor, and I highly recommend talking to a professional. Someone can find you the best places to put your money going forward. In addition, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. I think at this point, pretty much everyone has a general understanding of Netflix as a company. They're the largest streaming platform out there with around 200 million active subscribers, and that's so much higher compared to a bunch of the other platforms like HBO, Hulu, Amazon Prime, that kind of stuff. So Netflix is definitely the leader in this sector. And so it might sound like kind of a surprise when I come out and say why I'm never going to be taking a position in something like Netflix. And based off of the stuff from the earnings and kind of just my general understanding of how their business is run, I think they've got a lot of red flags going up. So in today's video, I'm going to be breaking down kind of the fundamentals and the big red flag that I see with the fundamentals, and just kind of discuss some of the problems that I see with the company and explain why I like Disney as a streaming service more than I like Netflix. And so besides earnings coming out this past week, the reason why I wanted to make this video was during the earnings report, Netflix said that they saw more search volume for their new series, The Witcher, than they saw for The Mandalorian. And I don't know, I assume most people have seen The Mandalorian, because as someone that spends a decent amount of time on social media, Baby Yoda is pretty much everywhere. And so I'll throw up some of my favorite pictures of Baby Yoda, but I thought that was kind of a strange claim and kind of a direct knock on a competitor, which I thought was kind of unprofessional in my opinion. And so that kind of got me thinking, well, if they're kind of putting their stance out that they think that they're doing better than Disney, I thought I'd kind of break down their company. Netflix has the fantastic title of being the best performing major stock in the 2010s with 4,000% returns since 2010, which is incredible. But when you look, currently the stock is around up 8% year to date. And when you look at the past 12 months, it's only up 8%. So 2019 was kind of a rough patch for it. So I'm going to break down the past couple earnings reports as an explanation on why the stock has fallen a little bit. So quarter two of 2019 is kind of where things started falling apart for Netflix overall. And so if you look at just the general numbers, I believe they added like 2.5 million subscribers during that quarter. However, this was the first time that Netflix lost subscribers in the US market, and the number was kind of saved by the fact that they've had incredible international growth in the past couple years. And you can see that in the quarterly reports since then. It's been very low on the US growth, and it's been very impressive with the international growth. And so this was kind of one of the first red flags that I saw. Obviously, international is an important part of their business, but the fact that people in the US are kind of going away from Netflix, I think it's a good indication that the competition in the streaming area is kind of getting to them a little bit. Quarter three kind of recovered some of the losses that they had in quarter two. And basically the summary of that earnings was amazing international growth and all right US growth. And so this is the trend that I've been seeing, is US has kind of been staying pretty slow, and then the international growth has been really impressive. And kind of comparing that to Disney Plus, I think Disney Plus has a fantastic business model. I recently watched a video of actually a comedian talking about just Netflix as a whole. And they kind of compared it to going to a restaurant that has like a 20-page menu, and there's just so many options. And you're kind of flipping through a lot of crap before you find something that actually piques your interest. And Netflix is kind of the same way. They have so many original shows and just shows in general that you can spend hours looking for something that is really interesting. Whereas something like Disney Plus, the stuff that they're putting out, people want to watch. I can pretty much go through Disney Plus and find something I want to watch within a couple minutes. And so now looking at the fundamentals of the company, when I put up revenue, the trailing 12-month revenue, it's probably one of the most impressive charts I've ever seen. Just the steadily increase in revenue, it's so impressive to look at. However, they've kind of counteracted that revenue with how much debt that they've taken on. I believe at this point they're kind of sitting around, I think it's $12 billion in long-term debt, which is kind of alarming. And so when I put up the debt to equity ratio, it looks pretty similar to the revenue chart. And so that means that they are increasing their long-term debt at an incredible rate. And while the equity has been increasing in the company, it has not been able to match how much debt they're putting in. Netflix has had a history of holding on to a lot of long-term debt. Just this past year, there were 2 different events where they had debt funding to raise around $4 billion in cash so that they could focus on Netflix originals, which I think is a good idea. I think it's really nice when a company is willing to take a risk and pull out debt to increase their business going forward. However, I'm kind of worried that Netflix is spending too much money on their own products, and it's not going to be enough in the long run. However, I think they're going to be losing some of that ground relatively soon. And while that's not a huge hit for the amount of revenue they're making, because as I showed that chart, they're making a lot of money. However, I don't think that the amount of debt, if they start losing subscribers, their revenue is going to drop, and being able to pay off that long-term debt will potentially be a problem for them. So this is the second time that I've kind of broken down a company that I love the product that they put out, but I don't necessarily love the fundamentals behind the company. So a lot of times on this channel, I've talked about the importance of finding a company you like before taking a position in it for people that are just starting out. Netflix is one of those kind of rarer examples of it's a company that I love and I use on a regular basis. However, some of the red flags, mainly the long-term debt and the loss of US subscribers, has been the main thing that's keeping me away from taking a position in it for a long-term position. In the past 3 years, I believe the stock's up around 140%, which is fantastic. However, when you look at the last 12 months, they're only up 8%. And so I don't think that Netflix is going to have the 2020s that it had in the 2010s. Obviously, 4,000% led all stocks, which is incredible. I just don't think it's the best opportunity going forward. And I think that some of that 4,000% growth that they've had in the past 10 years will be given back as the stock has to figure out what to do with all this long-term debt if competitors continue to be a detriment to the company. On this channel, I've talked a decent amount about PE ratio, which is price over equity ratio, and as a decent way of kind of looking at if a company is potentially underrated. And when I looked at Netflix, I was like, whoa, that's really high. I believe it's currently sitting around 200, which is very high for the stocks we've talked about. However, I don't think that's anything to be afraid of, just based off the fact that when I put up the history of the PE ratio, it has been up as high as 400 before. And so PE ratio is kind of a tough fundamental thing to look at, just based off of a lot of these tech companies grow at such a rapid rate that the PE ratio gets artificially inflated. Well, I guess it's not artificially inflated, it's just so high based off of the growth that the company sees. And so having a PE ratio for most companies at 200 will be kind of alarming. However, Netflix has shown that they can handle being at something as high as 400, so it's not something that I'd be worried about. One of the things I really enjoy about the company is that their earnings per share and revenue have been steadily increasing. When I throw up earnings per share, you can see that over the past couple quarters, things have been going very well. As I mentioned, the long-term debt, I think, is what the big problem with the company is. You can be making all this money when things are going well, but if there's a recession in the next couple years, competition starts to increase, I think Netflix is going to have a real problem getting rid of that debt. So now that I've kind of broken down my fundamental analysis of the company, let's head over to the charts and take a look at what I see for the technical analysis side. And then we're going to compare it to what the 12-month outlook for the analysts are. All right, so here we are on Robinhood. As you can see, kind of a tough day for Andy's portfolio. Everything that I own is red, besides Bitcoin, obviously. As we come down here and take a look at my watch list, most things are pretty red. Not super surprising, but it's kind of surprising when you come to TD Ameritrade that Netflix is up 1% today. So it is going the opposite way of the market, which is always interesting to look at. This is a company that I did technical analysis a couple of months ago, I think back in October. Let's see where it was in October. October, it was starting on its way up, and I think I was pretty bullish on it overall based off of this nice support, and then the earnings pushed it back up. So basically things I have to say for this, I don't see anything that's a giant red flag on the charts. I charted out some important areas in the past. This was a gap area, and it looks like it had some problems breaking through it, but with the earnings yesterday, or this week, has pushed through it. So that's not really a warning area. Now I'm looking for the break above 377 or 375, that type of area, which has been a problem area all the way back to October of 2018. So it's been a while since it's pushed above that. But based off the charts, there's nothing really that I see here that's giving me the red flags. Everything looks good. You see the normal spikes in earnings as earnings come out. And then I just want to show the 10-year month chart just to show the crazy 4,000% returns that it's had in the 2010s, going from $3 up to $400. So pretty impressive as a stock. Technical analysis on the side, not super important, just based off the fact that it's not close to a support. It's getting closer to a resistance, but it still has a while to go. And I think based off of the fact that since it's up 1% on the day and the market's pretty red, I think it's still kind of riding off the highs of the earnings from 3 days ago. As we go on to CNN Money, since I recorded the other part yesterday, it's now up 9%, where it was 8%. 5-day change up almost 4%, which is pretty solid. As we come down here, you can see what I was talking about with the revenue and earnings growth, which is very impressive. It's hard to talk bad about that. As we come down here, you can kind of see that CNN is kind of agreeing with me on the fact that Netflix looks like it could be kind of risky. They have it as the lower end of being down 50% and the upper end of being up 26.7%. And that's not ideal when you're looking for taking a position in a company for a long-term bet. You want something that's kind of skewed in your favor. And based off of what they're saying here, they have the median as being up 13.5%, up to $400, which is good. But it's kind of skewed to the bottom side, which is kind of agreeing with my position that there's a lot of risk associated with the company. When we go to Yahoo Finance, which has been notoriously bearish on companies overall, I think it's really interesting that they come here and they have it as up in the short, medium, and long term, and near fair value. They have their 1-year target estimate. I don't know how often this is updated, so I don't really like to talk about it that much, but they have it as only $9 higher than where it is currently, so just a couple percentage points. But the fact that they have it as up in the short, medium, and long term is kind of surprising. As I've mentioned, notoriously bearish. And when I see bad things in companies, I kind of expect to see that Yahoo Finance feels the same way, but apparently they don't. Apparently they're feeling good about Netflix for the long run. Overall, Netflix is probably one of the largest tech companies out there, and they're one of my favorite products to be using. However, I think I've made it pretty clear in this video that I don't think it's worth the risk taking a long-term position. But I want to also make it clear that anyone that is currently in this company or is looking to be in this company in the upcoming future, I have nothing wrong with that. Similar to the Uber stock, I've talked about how I currently hold a decent amount of risky positions, stuff that could go very well and I make a lot of money, or it could go very south. And adding something like Netflix, where I have a high perceived risk associated with the company, just doesn't fit my portfolio style. So I have no problems with people owning the company. I just am saying that I don't think I will ever take a position in the company based off of what I see with the fundamentals and the trend with the competition. So let me know what you think about Netflix overall. Do you like the company? Do you like the fundamentals? Do you think that long-term debt is a huge problem for the company? Or do you think that they're going to keep increasing their revenue and it's not going to be a problem? Let me know in the comment section down below. Also, if you have a video or just an idea you'd like me to go over in a future episode of the show, also leave it down in the comment section down below and I'll get to it as soon as I can. Thanks for watching this episode of Robinhood Top Stocks, or Andy taking a crap on your favorite company, and I'll see you in the next episode. Thanks for watching.